Your mortgage payment didn't change. Your property tax went up, your HOA went up, and your homeowner's insurance, the one that was $800 a year when you bought, just renewed at $6,400. You didn't file a claim. You didn't change anything. The house is the same house. The number is just different now, and it is going to be different again next year, and the year after that, and the insurance company that sent you the renewal letter cannot guarantee it will still be writing policies in your county when that letter arrives. This is not a hypothetical. This is the lived experience of homeowners in 12 Florida cities right now, and it is destroying the housing market in each of them in a way that lower mortgage rates cannot fix, because the mortgage is not the problem. Florida has lost 12 insurance companies in 4 years. 6 more have stopped writing new policies in specific coastal and high-risk counties. Citizens Property Insurance, the state's insurer of last resort, the one that exists because the private market left, now carries more than 1.3 million policies. It was designed to be a backstop for a small percentage of the market. It is now the primary insurer in large portions of the state. When the backstop becomes the foundation, the structure it is supporting is in a different kind of trouble than the headline numbers show. 12 cities. The insurance data, the housing data, and what the combination means for anyone who owns is trying to buy or is watching a market that has been telling itself for 30 years that the risk is manageable. Let's go. 12. Homestead sits at the southern tip of Miami-Dade County, 30 miles from downtown Miami, and carries the insurance profile of a community that Hurricane Andrew destroyed in 1992, and that insurers have been repricing ever since. Average homeowner insurance in Homestead now runs $5,800 to $7,200 per year for a modest single-family home, on housing stock with a median price around $380,000. That ratio of annual insurance to home value is among the most stressed in the state. New construction permits have slowed significantly as the insurance cost burden makes pro forma numbers on new housing unworkable at the price points the local buyer base can absorb. A Homestead homeowner who bought in 2020 at $285,000 is now carrying a monthly cost, mortgage, insurance prorated, property tax, HOA, that is $480 higher than when they bought without a single change in their loan. Every dollar of that increase comes from insurance and tax. Their income has not increased $480 per month. They are making a decision about how long they can sustain a gap that they did not agree to and cannot negotiate away. Homestead insurance math brutal, or still buying South Dade? Drop it. Next city proves the crisis is not just coastal. 11. Fort Myers. Fort Myers was hit directly by Hurricane Ian in September 2022, one of the costliest hurricanes in American history, with insured losses exceeding $60 billion. Ian did not just damage Fort Myers, it recalibrated how every insurer in Florida prices risk in Lee County and the surrounding region. Average premiums in Fort Myers Metro have increased 60 to 80% since Ian. Several insurers that were writing policies in Lee County before the storm have exited the state entirely since. The ones that remain have repriced so aggressively that the monthly cost of home ownership for a $350,000 Fort Myers home, all in, has increased by $600 to $800 per month from pre-Ian baselines in some cases. Fort Myers Beach, the barrier island community closest to Ian's landfall, has a rebuild rate that is running significantly below what post-disaster economics would normally produce. Homeowners who received insurance settlements have in significant numbers chosen not to rebuild on the same site. They are doing the math on what it costs to insure a rebuilt structure on a barrier island in a post-Ian insurance market and deciding the math doesn't work. That decision, made by thousands of individual homeowners independently, is producing a permanent reduction in the housing stock of Fort Myers Beach that will not be recovered through normal market activity. Fort Myers Ian changed everything, or Beach will recover. Comment below. 10. Cape Coral. Cape Coral has more canals than Venice, and right now more for sale signs than canals. Active listings up 51% year over year. Price reductions on 31% of listings. The insurance dimension is what converts those headline numbers from a real estate correction into a structural market problem. Average homeowner insurance in Cape Coral now exceeds $8,000 annually in many zip codes. For homes on a canal, it can reach $10,000 to $14,000. An investor who bought 3 properties in 2021 reports his combined insurance costs went from $4,200 to over $19,000 in 3 years. He is selling at a loss because carrying costs exceed the loss on sale. That calculation, multiplied across thousands of Cape Coral property owners, is the engine of the 51% inventory surge. The market is not crashing because buyers disappeared. It is being listed by sellers whose arithmetic stopped working. Citizens Insurance, the state's backstop carrier, holds a disproportionate share of Cape Coral policies. Citizens has announced rate increases and depopulation efforts, pushing policies back into the private market at whatever rate the private market will accept. The private market's rate for a canal front Cape Coral home is producing sticker shock that is visible in real time in the listing activity. Cape Coral Insurance killed it, or Canal Life still worth it? Drop it below. 9. Northport, Sarasota. The Sarasota Northport Metro received a direct hit from Hurricane Ian's outer bands and has been absorbing the insurance repricing that followed. But the more consequential insurance story here is the post-Surfside condo inspection mandate that is running parallel to the storm insurance crisis. Condo owners in older buildings across the Sarasota area are receiving special assessments, mandated repair bills from structural inspections that in some cases exceed $50,000 to $150,000 per unit. A Sarasota condo owner received an $87,000 special assessment on a unit she paid $285,000 for. The insurance on that unit has tripled. The math of ownership has been restructured by 2 simultaneous and independent forces: storm insurance repricing and structural inspection liability, in a market that was already softening from overbuilding. Listings up 48% year over year in the metro. The condo segment is experiencing the most acute distress as forced sellers, owners who cannot afford the special assessment, add involuntary supply to a market that already has too much. When sellers are in the market because engineering reports require it, not because they want to sell, the price discovery process produces outcomes that voluntary sellers in the same building then have to compete with. Sarasota double crisis, or condo buyers must know this. Drop it. 8. Tampa dodged direct hurricane strikes for over a century, a statistical anomaly that shaped the city's insurance culture in ways that are now colliding with a revised risk reality. Tampa Bay's geography makes it one of the most vulnerable metropolitan areas in the United States for storm surge from a direct hit. The insurance industry has been repricing that vulnerability for the past several years, regardless of whether a major storm has actually hit. Average homeowner premiums in Tampa Metro are now running $6,000 to $9,000 per year in many zip codes. The condo special assessment crisis from post-Surfside inspections is hitting Tampa's significant older condo stock simultaneously. A buyer who was qualified for a $400,000 Tampa home in 2021, when insurance was $2,200 per year, may no longer qualify for the same home today because the insurance premium increase has moved their debt-to-income ratio past the lender's threshold. The insurance increase alone has disqualified buyers. That is a new mechanism of market damage that the housing data does not cleanly capture. Listings up 41%, price reductions on 27% of listings. But the number that defines Tampa's insurance crisis is not in the real estate data. It is in the mortgage application data. Loan officers in the Tampa market are reporting a meaningful percentage of loan applications being affected by insurance cost increases that push DTI ratios past approval thresholds. The insurance company is disqualifying buyers that the bank would otherwise approve. That is an insurance problem expressing itself as a mortgage problem, expressing itself as a housing market problem, and it is new. Tampa DTI insurance problem real, or Bay Area risk overpriced? Drop it. Next city shows the crisis spreading inland. 7. Orlando. Orlando is not a coastal city. It sits 60 miles from the nearest beach. It does not have the storm surge exposure of Tampa or the canal flood risk of Cape Coral, and its insurance market is still breaking down, which is the single most important data point in this entire video because it proves that Florida's insurance crisis is not a coastal problem. It is a statewide structural failure of the insurance market that is being felt in places that have no reasonable actuarial justification for the premiums being charged. Orlando homeowner insurance has increased 40 to 55% in 3 years. The increases are driven partly by the reinsurance market repricing Florida risk at the state level. Insurers who write policies in Florida must buy reinsurance to cover their exposure, and reinsurance costs have skyrocketed for all Florida risk, coastal or not. An Orlando homeowner in a suburb that has never flooded, never been hit by a major storm, and has no material weather-related claim history is paying insurance premiums that reflect the actuarial weight of Cape Coral and Fort Myers. The statewide risk pool is redistributing coastal catastrophe costs to inland homeowners who have no recourse. Orlando's housing market is correcting from overbuilding, listings up 36%, price reductions on 22% of listings. The insurance increase is a secondary pressure on a market that was already adjusting, but the inland insurance crisis reveals the mechanism by which Florida's coastal catastrophe risk ultimately becomes a statewide property value problem. When the reinsurance market prices Florida as a single high-risk zone, every Florida homeowner pays for the tail risk of the coast. The discount that inland Florida was supposed to offer relative to coastal Florida is being compressed by a market that no longer fully prices that distinction. Orlando inland should be different, or reinsurance explains everything. Drop it. 6. Jacksonville. Jacksonville was Florida's safe real estate market for the past 5 years. Affordable relative to South Florida, less hurricane exposure than the Gulf Coast, a growing economy, and a military presence that provides stable employment and housing demand. The insurance market did not honor the safe classification. Average premiums in Jacksonville have increased to $4,500 to $6,000 annually in many areas, well above the national average for a city that has not had a major hurricane strike in decades. Active listings up 47% year over year, price reductions on 28% of listings. The affordability premium that made Jacksonville attractive relative to Miami and Tampa is being systematically eroded by insurance costs that don't differentiate between Florida markets the way buyers do. A Jacksonville homeowner who bought in 2020 at $1,800 annual insurance received a renewal at $4,900. Their mortgage is unchanged. Their insurance costs nearly tripled. The monthly payment that qualified them for the home, and that they have been budgeting around for 4 years, has been restructured by a bill they did not agree to and cannot renegotiate. They are not in foreclosure. They are in the quiet financial distress of someone whose cost of ownership keeps increasing past the pace of any income growth they can produce. Jacksonville's safe Florida myth, or Northeast FL, still holds. Drop it. 5. Ocala in north central Florida is a horse country town that became a pandemic-era real estate darling because it was cheap inland and accessible from both Orlando and Gainesville. Retirees came, remote workers came, investors came. And then the insurance market came. Because Ocala is in Florida, and the reinsurance market prices Florida, average premiums in Marion County have increased 45 to 60% in 3 years, a community that marketed itself as affordable Florida. The version of the state that hadn't been ruined by coastal prices is now paying insurance premiums that compress the affordability margin that made it attractive in the first place. Listings up 33%, price reductions on 24% of listings. The inland discount is shrinking. Ocala's signal is the cleanest proof of the inland redistribution mechanism. A town with minimal actuarial storm risk, no coastal exposure, no material claims history, paying insurance premiums that have increased 50% in 3 years because it carries a Florida zip code. The insurance market has decided that Florida is Florida regardless of geography. The buyers who came to Ocala for affordable Florida are discovering that affordable Florida is a smaller category than it was. Ocala inland should be exempt, or Florida is Florida insurance-wise. Drop it. 4. Miami's insurance crisis is the most layered on this list because it operates at multiple price points simultaneously. A Brickell condo investor who bought at $620,000 in 2021 now carries $5,400 per month in total costs. Mortgage, HOA, insurance, property tax. The unit rented at $3,800 after sitting empty 2 months. He is losing $1,600 per month on a rented unit. The HOA fee increase, driven partly by post-Surfside structural repair mandates, and the insurance increase arrived simultaneously and permanently restructured the return profile of condo ownership in Miami in a way that the 2021 purchase price did not anticipate and cannot be renegotiated away. At the entry level, the $350,000 to $500,000 condo that represents the accessible tier of Miami home ownership. The insurance and HOA cost structure is producing monthly payments that exceed what the rental market will support. Owners in this tier are not wealthy investors who can absorb a $1,600 monthly loss. They are teachers, nurses, and local government workers who bought the most they could afford and are now being squeezed from the cost side in ways that have no resolution except sale or distress. Miami's condo deconversion rate, buildings converting from condo ownership back to rental operation because individual ownership has become financially unworkable, is rising. This is not a fringe phenomenon. It is a structural market response to a cost of ownership structure that has made individual condo ownership in certain buildings and price tiers functionally unsustainable. When ownership structures convert to rental operations because ownership is broken, the direction of value is not ambiguous. Miami condo math is broken or deconversion new to me, drop it. 2 cities left, 3. Daytona Beach and Volusia County. The Daytona Beach Metro has become one of the most acute insurance stress zones in Florida outside the Gulf Coast. Multiple insurers have stopped writing new policies in the county. Citizens holds a disproportionate share of existing policies. The county's housing stock skews older. A significant portion was built before modern building codes, which means structural vulnerability that the post-Ian insurance market prices aggressively. A 3-bedroom home in Daytona Beach that would have insured for $2,600 in 2019 is now generating quotes of $5,000 to $7,500 when quotes are available at all. The phrase, "when quotes are available at all," is not rhetorical. There are property owners in Volusia County who cannot obtain private market coverage and are forced to citizens at rates that make the monthly cost of the property functionally unaffordable. When a homeowner cannot obtain private market insurance and must use Citizens, the insurer of last resort, at distressed pricing, their lender's insurance requirement is technically met, but the economic reality of the homeownership has changed fundamentally. The backup is being used as the primary. The backstop is holding weight it was never designed to hold. If Citizens faces a capital shortfall after a major storm event, which it would in a worst-case scenario, its policies are backed by assessments on all Florida insurance policy holders. Every Florida homeowner is a silent co-signer on the state's insurance backstop. That is not a fringe scenario. It is written into the Citizens structure. Volusia Insurance Availability Problem, or Citizens Backstop Risk Real, drop it below. 2. Pensacola, Northwest Florida. The Pensacola, Fort Walton Beach, and Panama City corridor is the part of Florida that the national media covers least and that the insurance market prices most severely among non-South Florida markets. This region has absorbed 3 significant hurricane impacts in 6 years: Michael in 2018, Sally in 2020, and Idalia adjacent impacts in 2023. Each event reset the insurer's risk model for the region upward. The cumulative effect of 3 resets in 6 years has produced insurance premiums that run $7,000 to $12,000 annually for homes in coastal Escambia and Okaloosa counties. For properties that are not beachfront, simply proximate to the coast in a region that has demonstrated it is in the active hurricane strike zone. Panama City Beach, which took a catastrophic direct hit from Michael in 2018 and rebuilt at significant public and private cost, is seeing a second wave of insurance market exits as the rebuilt stock ages into its first major renewal cycles post-reconstruction. Homeowners who rebuilt with full confidence that their new code-compliant construction would produce better insurance outcomes are discovering that the insurer's concern is not the building's quality. It is the zip code's location in a repeatedly struck geography. Code compliance does not move you out of a hurricane impact zone. NW Florida repeated strikes problem or panhandle still worth it? Drop it. 1 city left. It is the one that defines the entire crisis. 1. The entire state of Florida, number 1, is not a city. It is the conclusion that 12 cities have been building toward, and it is the one that the Florida real estate industry, the Florida legislature, and the Florida Chamber of Commerce have been trying to avoid stating plainly. Florida's insurance crisis is not a market inefficiency that will correct when conditions improve. It is the insurance industry's actuarial response to a physical reality. Florida is in the path of increasingly intense Atlantic hurricanes. Its coastline is among the most exposed in the world. Its older housing stock was not built for current climate conditions, and the legal and regulatory environment that produced years of claims fraud has left the market with a distrust of Florida policies that drives costs upward independent of the physical risk. 12 insurance companies have left Florida since 2020. The legislature has passed reforms intended to reduce claims fraud and litigation abuse. Those reforms are real and they are working at the margins. They are not working fast enough or large enough to reverse the repricing that has already occurred. The private market that exits rarely re-enters at the same price it left. The reinsurance market that has repriced Florida risk upward does not reprice it back down when one legislative session passes a tort reform bill. The housing market implications are still being priced in. A state where homeowner insurance has tripled in 5 years is a state where the monthly cost of ownership has increased by $300 to $600 per month on median priced homes without any change in the mortgage. That increase is not temporary, it is structural. It is based on physical and actuarial reality that legislative action can influence at the margins, but cannot fundamentally reverse on any near-term timeline, and it is progressively reducing the pool of buyers who can qualify for Florida mortgages, the pool of investors for whom Florida returns justify the carrying costs, and the pool of retirees for whom Florida retirement arithmetic works on a fixed income. A retired couple from Ohio is doing the monthly Florida home ownership calculation for the 3rd time since their renewal arrived. Mortgage, $1,840. Property tax monthly, $390. HOA, $280. Insurance monthly, $540. Total, $3,050 per month. When they bought in 2021, that number was $2,340. They have not done anything differently. The house is the same house. They are $710 per month further back than they planned permanently in a fixed income retirement that was modeled on $2,340. They are not in foreclosure, they are in the specific financial stress of people who planned carefully and accurately for a future that was restructured by a line item they didn't know was variable. They are making a decision. A lot of Florida homeowners are making that decision right now. The listings data is what those decisions look like in aggregate. Florida is not becoming uninhabitable. Florida is becoming unaffordable to own in a specific, structural, insurance-driven way that is distinct from the cyclical affordability problems that resolve when rates move or prices correct. This is the thing the market is in the process of pricing, slowly, unevenly, without a clear bottom. And the 12 cities on this list are the places where the pricing process is most visible right now. If you own in any of these markets, the insurance line item is the number you need to watch, not the Zestimate. Get your renewal quote early, understand what Citizens coverage means for your property and your lender requirements. Know your HOA's reserve study and special assessment history. The costs that are rising are not the mortgage, and the costs that are rising cannot be refinanced away. If you are thinking about buying in Florida, the insurance quote is not a detail. It is a pre-offer research requirement. Get quotes before you make an offer. Understand what the Citizens depopulation process means for properties currently on that policy. Ask for 5 years of insurance cost history on any property you are serious about. The number you are quoted today may not be the number you are quoted at renewal. Drop your Florida city in the comments. Tell me what your renewal came in at and what you paid 3 years ago. The data in this video came from public filings and industry reports. The lived experience, the actual renewal letters sitting on actual kitchen tables, is more specific and more real than any data set. Drop it below. Subscribe. Because Florida's insurance story is not finished. The next legislative session, the next hurricane season, and the next round of reinsurance negotiations are all going to produce chapters that this market needs to be paying attention to.